Hey everyone, this is Logan Hertz with Hazeltine LLC. We are continuing our series of interviews with financial professionals in the industry that have a lot more experience than me, and I am beyond excited to have with us today Mr. Chris Kirkpatrick, who is one of the titans in the industry. Chris Kirkpatrick is the author of Cashflow Hacking. He's the founder and CEO of Life180. He is a big believer in the power of whole life insurance, and he helps his clients to achieve financial freedom. And we're very excited to have him with us today. So, Chris, how are you doing today?
I am doing awesome. I mean, it's almost Christmas time. I'm getting ready for my move to the Dominican Republic. I got like a week left in the United States, and then I'm out of here for a while.
That's awesome, man. That's
It's
awesome.
gonna be fun.
Never been to the Dominican Republic, but maybe I'll
Well, you'll
stop
have to
by and
come
see
visit.
you sometime.
We're gonna be running a mastermind for agents in I think March or April, so I'll let you
Okay.
know.
All
Cool.
right. All right. Yeah.
Yeah, yeah.
Keep me in the
It's gonna be
loop. Keep
awesome.
me in the loop.
Yeah, yeah.
Okay. Yeah. So I always like to start with
Yeah.
your why. Like, why do you do what
Yeah.
you do?
Yeah, I mean, I think for me, my why is really just about helping people. I think the financial system that we live in is just broken. It's not set up for people to succeed. And I've been blessed enough to have experiences and mentorship and whatnot that have led me down a path that have allowed me to create a pretty cool life and create a cool business and do some really fun investments and hence the Dominican Republic and what we're doing with our family there and whatnot. But my real passion is like I love to educate people as to understanding what they can do to have control of the results in their life. I'm a big believer that everybody's after financial freedom, right? Like, and we can call it retirement, we can call it financial independence, we can call it whatever we want, but at the end of the day, it's freedom is what people are after. And I run it through a filter, and I call in the book that I'm writing, my Cashflow Hacking 2.0 book, I talk about the 5 F's of life, and it's faith, family, fitness, finances, and freedom. And everybody wants to get to freedom, but I don't think there is true freedom without a good relationship with your higher power. I don't think there is a any real freedom without good relationships with your family, without health, fitness, without good, your ability to be financially free. And there are plenty of people that go in and they say, all right, I can be wealthy and rich and have plenty of money, but they sacrifice their relationships and their family. They sacrifice their health and all that stuff. And then they get to retirement. I've had too many people I know that get to retirement and then they die in the first 5 years because they're not healthy, and they regret the relationship. So my real why is helping people figure out how can you build a financial and take control of your finances, because I think most people would say, all right, I know that I can't outsource my success with my higher power. Like, I've got to pray, I've got to read the Bible, I've got to do these things. Sure, it's great when people pray for me, but like, at the end of the day, my relationship with God is my relationship, and that's on me. I can't outsource my success as a husband, as a father, right? Like, that's got to be on me. I can't outsource my success with my fitness and my health. And those are all three of the four pillars. Now, with finance, somehow people have been duped into believing that you're too stupid to take control of your own money and you're not taking accountability for your own results in your life. And so what I love to do is help people align their money with their values and beliefs and really understand, like, what is it that you're trying to accomplish? Do the old Stephen Covey thing, start with the end in mind, reverse engineer a plan to get there, and realize that the reason you are where you are in life is because of who you are in life. And if you want to grow, you're going to need to become somebody different than you are right now. And
Yeah,
that's
you
it.
talk about aligning your money with your values and beliefs, and I love
Yep.
that phrase. That's one I give you credit for because
Thanks.
Peter Nelson, one of my colleagues, I think a
Hmm.
lot of us in the industry, one of the things we discover really early is you
Yep.
don't want to tell people anything. You want to ask them questions to have them
Totally.
self-discover, right?
Hmm.
And
Yep.
so some people think I'm against retirement accounts. Well,
Sure.
not necessarily. I would just
Hmm.
ask a question. Okay, why are you doing that? Like, what's the
Hmm.
thought process behind this? What do you actually believe about the future, right? And depending on your answers to the questions, maybe it does make sense,
Yep.
right? I mean, I can absolutely see use cases where it might make sense to contribute
Totally.
to a retirement account.
Hmm.
But so many people, they just start contributing to a 401k because it's the right thing to do, right? And they're
Hmm.
saving for retirement, right? And it's
Hmm.
like, what thought went into this, right? And if you ask them questions, it's not too hard to figure out that, yeah, what you're doing there is not really in line with what you believe, right?
Yeah. I think it's like anything. There's a couple things I would say to that is, first of all, the power of the subconscious mind is one of the most powerful forces in the world, right? And I talk about it quite a bit because I think it's so important. There's a book that was written. It's called The Ant and the Elephant, and Vincent Pacenti talks about this study that was done where they actually scanned the brain, and they said when we make conscious decisions, when we consciously choose to try to lose weight, eliminate debt, and just kind of like, all right, I'm gonna make this happen. I'm gonna grit my way. I'm gonna white knuckle through this. I'm gonna be more diligent and do all these things. I'm gonna download an app to help me eliminate my debt and do all this stuff. That's a conscious decision. When you make that conscious decision, you have 4 million neurons in your brain firing off per second. When your subconscious is operating, you're operating at 4 billion neurons a second. And your subconscious is all your years of programming growing up, all your subconscious beliefs and habits and things that if you think you're going to just be able to just consciously override your subconscious without really reprogramming your why and understanding that, then it's the equivalent of an ant sitting on the head of an elephant thinking it has the ability to steer the elephant. And so that's where my statement of you need to align your money with your values and beliefs, because there is no way you're going to be able to reprogram your subconscious without really aligning your money with your values and beliefs and understanding what your beliefs are. And that's the other thing, is like the human brain, and this is another study that's been done, the human brain will not let you put 100% of effort into something that you subconsciously don't believe with 100% certainty that you can be successful. Not that you will, but you could be successful. And so when we're operating out of correlation with what we actually believe, what we're actually concerned with, what's going on in the world, even if you don't realize you're doing it, but when we're being reactive with our money and that reactive nature is being out of alignment with our values and beliefs, our subconscious is going, whoa, something doesn't make sense. This doesn't feel right. And so therefore, that's why people are undersaving. That's why people are not acting in their own best interest. And that's why people, in the most prosperous world or country that we've ever had in the history of the world, people are hitting retirement at a 95% clip and not able to maintain their standard of living when they retire. And that is like, everybody's worried about like the pandemic. That's the real pandemic right now.
Yeah. Now, I have to bring up whole life insurance and how we incorporate that into the discussion. Now, whole life insurance is not the end all be all. It is like anything else. As I've said before, I am not for or against any particular financial product. It's all about what is your overall strategy? How does it fit into your overall financial picture, right? I don't make dogmatic statements that this product is bad and that product is good. That's like saying real estate is bad or real estate is good. Well, I mean, real estate can be phenomenal or it could be terrible depending on how it fits in, right? One of the phrases that you coined, and by the way, you are a marketing genius when it comes to coining phrases. You're looking at the worst sales and marketing guy you've ever met. I belong like in academia with like boring, textbooks in front of a chalkboard. That's where I belong. I'm terrible with sales and marketing. But people talk about buy term and invest the difference, right? Now, I'm happy to say I never heard this phrase, nor did I ever know what whole life insurance was until I discovered the infinite banking concept. And I'm happy to say most of the people I talk to don't know, have never heard of whole life insurance and have never heard the phrase buy term and save the difference or invest the difference, right? So for me, it's kind of, I kind of don't deal with objections. I just educate, and the objections then come up because once you clear up the misconceptions, no problem. But you coined the phrase buy term and save the difference. And I love that because like Peter Nelson, another guy who I talked with, one of his big things is it's not term versus whole life, right? No, it's not like these two are competing. It's term and whole life, right? Both of them.
Yes, for sure.
So can you talk about what you mean by buy term and save the difference?
Well, I think, it really stemmed through the fact that the whole buy term and invest the difference concept is a counter punch to the whole life.
Don't call it a concept. Don't give them too much credit. It's not a concept.
It's
a marketing
pitch,
phrase.
Marketing
it's sales
scheme,
gimmick.
Whatever it is. So that idea, that philosophy, which is a horrible, failing philosophy in my opinion.
No, Chris, it's successful. It is very successful in its actual goal, which is not to help you be financially free, but to make you particular company
Yeah,
pushing
yeah,
it.
no,
So give credit
that's
where
true.
credit is due.
Okay, that's fair. Yeah, speaking of marketing genius, Dave Ramsey's a marketing genius, but like, he's a hypocrite too. But that's another conversation. The buy term and invest a difference idea, they created it because they were trying to tell you whole life insurance is a horrible investment, so you should buy term insurance and invest the rest in mutual funds. That's really the simplicity behind it. And so what really irritated me with that is that, first of all, I think there's a real crisis in this country with the fact that people are investing way too quick. They're not saving enough money. And the function between investing and saving is a function of risk. And if people are investing before they have enough safe, liquid, accessible capital, you're not even an investor, you're a speculator, right? And speculators get crushed when the market cycles happen. And I can show you historically, and it's a whole different video probably, but during the different market cycles over the last 40 years, the reason the wealthier are getting wealthier and the middle class is getting poorer is because most people have bought into the lie that the younger you are, the more risk you can take. When in fact, the younger you are, the less risk you have to take or should take because you have time and compounding on your side, and you understand that you need to prepare yourself, build your foundation, prepare for the market cycles, and instead of trying to make 8% per year, make 4 to 5% per year. And then when the market takes a crash, make 100, 200% in those couple blips of a period. And that's where opportunity comes from. So my idea of buy term, save the difference is that I believe in the concept that life insurance is important. I think everybody should have a portfolio. We talk about diversification. I think everybody should have a portfolio of life insurance products because not all life insurance is the same. And I think that's what people are confused about. When we look at life insurance, there's cheap term insurance, which I think has its place. There's living benefits term insurance, which absolutely has its place. There's convertible term insurance, which is amazing, which absolutely has its place. Most people don't realize is, they think all term insurance is created equal. No, there's 3 different types that I could quantify in all the different companies, and none of them are able to perform all the functions that you need. And so what I look at is like, all right, there's a thing called human life value. Like, well, you can never buy too much insurance. I'm in underwriting right now for $2 million more of insurance right now because I knew I could qualify for it. I'm always going to max out whatever the life insurance company is going to give me. Why? Because they're not going to give me more than I'm actually worth. So I use a phrase called buy your net worth, build your cash flow, right? Because I'm a big believer in people need to invest for cash flow. And I say buy your net worth. The reason I use buying your net worth is because I think the idea of human life value is confusing to people, right? And people are like, what do you mean human life value? Like, basically, when you go to an insurance company, they're gonna try to quantify your human life value. And to break it down simply and to make it make sense to people, what I do is I say, your human life value is basically the insurance company is evaluating where you are right now, Chris. And they're looking at you and they're saying, based on where you are, what your debts, what your assets, what your income, what your capacity is, if you just operate as a diligent human being and you save money, we think your future wealth potential is X. That's what they're going to insure you for. That's it. Like, that's it. That is what your human life value is. So think about the power behind that. For me, as a husband, as a father to 3 kids, as a business partner that has a lot of people, I have a whole community, I have an agency, everybody relying on me. The responsibility that I have to that is massive, right? And so for me to be able to say, I can utilize a product for pennies on the dollar to actualize my potential net worth. Because if we think about why we're here and why we're doing whatever we're doing and for who we're doing it for and all these things,
By the
like,
way, that's another great phrase you just said, to actualize my potential net worth. What a great way to put it. That's so true.
I
It's
mean,
like, hey, in theory, I might make $3 million, or I could actually secure it now before I've actually gotten it, right?
totally. So think about this. If my potential net worth is $10 million, hypothetically, right? Like just using round numbers. If my potential net worth is 10 million, I can work hard and not use life insurance, and I can work towards that, and maybe I'll get there, maybe I won't. Or I can say, you know what? I'm going to use a life insurance company. I'm going to buy my net worth. I'm going to secure that net worth, and then I'm going to build my cash flow to work towards it. And if something tragic happens along the way, everything I wanted to complete in life, maybe not everything, because obviously being a role model and a mentor and everything to my kids and all that stuff, that's a different story. But financially, and what I'm trying to accomplish from a legacy perspective and the impact in the world. If I use trust, I can do that. That's a whole different thing. But like, I can actually guarantee that what I want to happen will happen when I want it to happen, whether I'm here to see it or not. And that's the thing, that you cannot implement a financial strategy that will help you actually create the life that you want to create and the legacy that you want to create on a guaranteed basis without life insurance. And this is the thing, is like, I think the thing I love the most about what we do, and the reason I love life insurance, it has to do with not the life insurance, it's the fact that when you implement and you embody this methodology, this strategy, it forces you to become who you need to be to live the life you want to live and make the impact that you want to make.
Yeah, so what we're talking about here with buy term and save the difference
Yeah.
is you are going to secure your full human life value. Let's say it's $3 million. Okay.
Mm-hmm.
You're going to have a combination of a convertible term policy with a company that has a competitive whole life product
Yep.
and a whole life policy. So
Yep.
between the two, you're fully insured for 3 million. You've locked in your net worth, right?
Yep.
No matter what happens to you, it's there.
Yep.
And over time, you will convert it. So eventually it's all whole life. And the savings portion goes into whole life insurance, right? Because
Yep.
of course, when they say buy term and invest the difference, well, that's not a fair comparison
Right.
because this is not an investment vehicle.
Whole
We're
life is not an
taking on
investment.
risk.
Yeah.
Yeah, we're not taking a risk. As Peter Nelson would say, it's the greatest savings vehicle ever invented by the human mind. That's what Peter Nelson says, right?
Yep.
It's a saving vehicle, right?
Mm-hmm.
Another way I like to say it is, Chris, if you're going to have a custom built house, okay,
Yeah.
are you going to build it yourself, or are you going to hire someone to build it for you who knows what he's doing?
Bro,
right?
I can't even build an IKEA shelf.
So if you want to, so Chris, if you want to build a $3 million legacy, I mean, you could do it
Yeah.
yourself. That'd be hard.
You
Like
could try.
blood, sweat, tears,
Mm-hmm.
make sure it stays away from the IRS, from attorneys, right? All that other stuff, protect it, do your best, right? Or you could just hire the experts, the
Yep.
mutually held life insurance companies, take out
Yep.
a portfolio of life insurance, probably a combination of convertible term and whole life for 3 million. Done. You
Totally.
just secured it. You just
It's
secured
done.
it.
Buy your net worth, build your cash flow. Lock in the guaranteed result that you're after in life by buying the term insurance. And then based on what your cash flow is, save that money in a whole life policy, and then work on building your cash flow throughout time. And you can work towards it. But think about the peace of mind that you have behind that process. And I'm a big believer that this strategy, not only is it going to help you achieve a more predictable result, but it's going to help you live longer, because I'm a big believer that, and I know that's a little woo-woo-y for a lot of people, but I am a big believer that, stress, uncertainty leads to health issues, leads to free radicals in our body, leads to cancer, leads to, all sorts of ailments. And if you could mitigate that, I truly believe that this strategy is going to help you live a healthier, happier life, which is going to help you live longer, which is going to, help you, ironically, actualize it even better and more effectively.
Yep. One of the 3 lies of Wall Street that Peter Nelson talks about is higher the risk, higher the reward, right?
Yeah, exactly.
It's like, no, that's the opposite of the case. What does Warren Buffett say? I got more money because I took on more risk.
Mm-hmm.
No. He says, rule 1 of investing, never lose money. Rule 2, see rule 1. And the reason we see this time and time and time again, I was talking with DeAndre Clayton about this because he's worked in Medicare, he's seen the senior community.
Yep.
Why are they not retiring peacefully? Is it because their investments didn't pan out? Is it because they didn't make enough money? No, it's almost always, I had this negative health event. I got diagnosed with cancer, and that erased my savings, right? My son got diagnosed with cancer, and it erased my savings, right?
Mm-hmm.
So what we do would protect us against this. I'm going to brag a little bit. I had a case recently of this guy. We had like we just talked about. We had a combination of convertible term and whole life. Okay. A couple years after that, he found out he had a serious heart condition, and he may have less than 5 years to live. Okay.
Oh, wow.
Not only was our financial plan not derailed by that, it wasn't even changed in the slightest. What did we do? Nothing different from what we had originally planned. We converted the 2 million to whole life like we had originally planned.
You probably
And
converted it with a lot more base though.
well, you'll be happy to know as part of that conversion, we 1035 exchanged an IUL
Ooh,
to,
nice.
into the new whole life policy. But the sort of plans that I think you and I build are plans that are not going to be derailed when a negative health event happens. That's my point.
Right.
When,
Yeah.
as you say, as Chris Kirkpatrick says, I love this. Life does not exist on a spreadsheet.
Nope.
Okay. I like to compare financial fitness
Yep.
to physical fitness.
Yep.
There's a huge psychological component to this, right? We can lay out a plan on paper, and of course, then we have to assume what is the market going to do, right? Who
Sure.
knows, right? But even with that assumption, well, what if you lose your job? What if your home burns down?
Yeah.
What if you get a frivolous lawsuit, right? And I don't say this to fearmonger. I say it because it's actually not that hard to account for all these things if we just look at it holistically.
Yeah.
Offense wins games, defense wins championships, right?
Hmm.
So
Yeah.
you called the five F's. I like the analogy of physical fitness and financial fitness, right? So
Hmm.
I like to say I'm like a good fitness coach.
Hmm.
So you have to do the work. Like I'm here to help you, coach you, design it, do whatever, but you have to do the work. I cannot do it for you, right? And in fact, like a
Yeah.
good fitness coach, I'm probably going to make you
Well,
do more work, not less, right? It'll be a
yeah.
lot less in the long run because now you can
Yeah.
retire 10 years earlier. But
Yeah.
there are three reasons why people are not physically fit. And it's the same three reasons why people are not financially fit. Okay. And it's not because they're stupid. That has nothing to do with it. Okay. Uh, Number one, they've been propagandized. When we say eat healthy, they don't know what that means. They think that means, well, eat less, eat vegetables,
Hmm. Hmm.
don't nourish yourself, right? Because fat is bad, right? Whatever, all this nonsense, right?
Sure, sure, sure.
Number
Yeah.
two, they're being poisoned, right? The food supply is poisoned, right?
Hmm.
And
The
so
toxicity we live in every day with our food is just atrocious.
yeah, yeah. And then thirdly, and they are in this order, lastly, they lack the patience and discipline to actually execute on some kind of a plan. Okay.
Totally.
That's the same
Yeah.
three reasons people are not financially fit. Number one, they've been
Yeah.
propagandized.
Yeah.
When they automatically think investment strategy, they're
Hmm.
myopically focused on this one sliver of their financial picture as if that's all there is to it. And it's all about this magic and irrelevant metric, which is return on investment.
Mm-hmm.
Who cares? Who cares? Okay.
Totally.
And then, secondly, they're being poisoned. The financial system has products and systems in place that are designed to extract wealth from you and give it to the financial institutions. And then,
Totally.
lastly, they lack the patience and discipline to execute on a plan. So I
Have
can lay
you?
out a plan with all a spreadsheet and show you
Yeah.
all these fancy numbers. None of
Yeah.
that is real. It's
Yeah.
better for us to have a more realistic plan that you can
Hmm.
actually execute on and won't be derailed by these negative events we talked about, right?
100%. Have you ever heard of the club versus the swing analogy?
No, no, I have not.
Okay, so this is kind of what I equate it to. So if you think about it, all like at the end of the day, everybody in their chase for financial freedom, retirement, independence, whatever you want to call it, financial products are going to come into play. I don't care if you're talking about real estate or stocks or mutual funds or bonds or whole life insurance or annuities or anything else. Products are products. Products are just clubs. So if I gave you like a golf, if you've ever played golf, and I think anybody that's ever played golf, as a competitive athlete growing up, like golf is the most frustrating game in the world to me, because I go out and I suck at it and I try to get better. And like, no matter how much, I swear the harder I try, the worse I get. And it's like super frustrating, right? And so like, but imagine if you think about the analogy that if you had the ability to go out there and if I said, hey, Logan, I'm going to give you two options. You could choose the best set of clubs in the world and choose the best clubs in the world. And I'm going to give you that choice, or I'm going to say you can have Tiger Woods' ability in his prime, and you have to use a set of beginner clubs. Which are you going to take?
Yeah, Tiger Woods all day
Tiger
long.
Woods all day long, because the swing, the ability, the hours, and who Tiger Woods is, and what he had to do to become that person is worth infinitely more than the actual product of the clubs. And that's the same way with personal finance. Like whole life insurance is different. I was having a conversation with somebody earlier, a person who was looking to get a policy earlier, and it all came down to he's a perfect fit for it because the idea of the value of access to capital, the value of what we do has different value to different people. It's good for everybody, right? But sometimes that access to capital for somebody like me or like this guy, maybe like you, is worth more than to somebody that is newer on the journey, that's just learning and that maybe doesn't have the discipline or doesn't know how to find the opportunity and stuff like that. But that's why I say, like, we need to save money first. And if you're going to save money before investing, where's the best savings vehicle? You need to build an emergency fund and an opportunity fund. Okay, whole life insurance just makes sense when you break it down. And we can go deeper or stay shallow, whatever on that. And that's fine. But then as you are saving money, the process of saving money and being willing to go slow to go fast, right, is what I say is, like, you got to be willing to save. And then that journey, that process of who you become in that savings process, as you slowly get access to more capital, as you slowly start leveling up and being able to see bigger and bigger and bigger opportunity to take advantage of, that patience and that discipline and that process of how you will grow to actually be a good investor, to be a good steward of your money, to be able to identify the right opportunities that are in alignment with your values and beliefs, is everything to your success. And that's why I always say, I think the thing I love about the most that we do when utilizing whole life insurance and term insurance as the foundational component of people's financial life is just the journey of watching how people grow in that process. That's the most fun part of this to me.
It's so satisfying. Yeah, that's why I love what we do. What we do is the opposite of sort of the standard Wall Street approach. The standard Wall Street approach says, I'm the expert and you're not, so you just give me your money and I'll do the work for you, right?
Yep.
We do the opposite. It's like, no, you're the expert. I can't tell you the best path for you to financial independence. You have unique gifts, you have unique skills. You know what that is. I'll help you discover it, and I will provide the framework for you to move forward. And I love it when my clients lap me, like they know more than I do. It's awesome. It's the most satisfying thing, where I have clients who have now had whole life for multiple years, and to see them discover, to your point, more of the power of it, right? Because obviously the longer the policy is in force, the better it is, right? It ages like a fine wine, right? And they're like, oh, now I'm doing this, and I just took out a policy loan to finance this, and isn't that awesome? Like, wow, I never even thought of that. That's great. Like, you're more creative than me,
Totally. I always tell people, if you don't love your family and you're not willing to take radical self-accountability for the results in your life, don't work with me, because that's what I stand for. And those are my values, those are my beliefs, and I only want to work with people that are in alignment with that. You know what I mean? Because that's what, like, and you don't have to be where I am. Like, I love to help elevate people in that journey, but you got to have the desire to get there and know what you're trying to build, And so, yeah, man, I mean, I love it. And to that point, like what you just said about, it aging like a fine wine. I actually just did a video. I don't even think it's public yet, but talking about how long do I have to pay on my policy? I think the most frustrating question that I get, like, because it's like people like, oh, I don't want to pay on it very long. It's like, why? Like,
Have you seen
like
what it looks like if I pay $10,000 and my account balance grows by $13,000? Why would you not want to do that? Just borrow the 10,000, pay it in, and then you could pay the loan right back.
Anybody that says that, my immediate response is that if you're saying that to me, it tells me you don't understand what you're getting involved with, so you're not ready for it yet. So let's keep diving deeper so you understand what you're getting involved with before starting.
Right. That's like saying, I did all this hard work to plant the seeds, and then when it comes time to harvest, that's too much work.
Exactly. Let's just let it rot in the field.
I dug this great gold mine, and now it's time to pull the gold out. Right. No, I always tell people, the number one psychological barrier we all have to get over when we start doing this, and we all have this to a certain extent, is we have to stop seeing the premium payment as a liability. It is not a liability.
Nope.
We should not be afraid of paying too high of a premium. We should be afraid of paying too low of a premium. Because when you pay a premium into your properly designed whole life insurance policy, you are permanently capturing that capital inside your personal economy, where it can never escape,
Yep.
where it earns for you from now until the day you die. Any dollars that don't go in there can escape, and they will escape,
For
right?
sure. For sure.
Um, so yeah, and I wanted to, I have to engage in a little bit more self promotion because it is my
Sure,
channel.
sure. Go for it. Go for it.
um, my, I had no idea how much good traction it was going to get me when I started this financial malpractice series with real
Mm.
life case, right? Showing sort of the standard financial advice and showing to me the shocking thing, maybe it won't shock you, but the shocking thing is how unbelievably ignorant these financial advisors are, and it's not all of them, of course, about even the most basic financial concepts about life insurance. Just the most third grade errors that should be embarrassing. I mean, this should be embarrassing.
It's
If I tell you
crazy.
whole life insurance and you ask me as a gotcha question, well, what's the cap on that? Okay, that tells me you do not know anything about life insurance,
Oh
right?
man.
You know,
Yeah. Hmm.
so I just want to get your thoughts on that whole series.
Yeah, no, I
You
mean,
can watch the
I
whole thing.
think, yeah, no, I love it. I think I watched 3 videos in it. And honestly, it's great. I think like that's why I said I'd do an interview with you because I think the work you're doing is awesome. I think,
Thank you. Thank
the
you. It
message
means a
you're
lot coming from
teaching,
you. Really appreciate that. Thank you. Thank you.
the message you're teaching is amazing. And I think the reason I'm doing this and I'm trying to like you don't work with my agency, like you don't like whatever, but I see what you're doing and my mission greater than my agency is to build this industry up and to help people and to get good information out there. And what I know is there are thousands and thousands of IUL agents that are misrepresenting and hurting people, and financial malpractice is a perfect word for it because it's or phrase for it because it's happening in just droves right now on social media and whatever. And so anytime I see somebody like you that's willing to like put yourself out there and get the right information out there, like to me, a rising tide lifts all ships. Like we just need more of that and we need more of the right information. So, I'm on a mission right now. I have no problem with competition. I think competition is healthy. And I realize not
Yeah.
everybody's going to be,
The
aligned with the
number
way I,
one, the number, I have to jump in because
yeah, go
this is
ahead.
something
Go
I
ahead.
noticed. I said it in financial malpractice, but
Hmm.
the number one difference I noticed between successful financial professionals, really you can
Hmm.
go to any industry,
Yeah.
and the unsuccessful ones, is that the successful ones do not view other financial professionals as competition. Like
No.
like DeAndre Clayton, he is an infinite banking guy. He and I do exactly the same thing. I had him on
Yep.
my channel more than once. Like,
Yep.
why would I view him as a competitor? Why would we be at
Your
each other's throats? I don't understand this, right?
your success doesn't equal my failure. Yeah,
Right.
right? Or
Wealth
like,
is not it's not a zero sum
like,
game, right? It's not
right.
like the only
Yeah.
way I make money is stealing it from you, and the only way you make money is stealing it from me, and we're fighting over the same piece of pie. No, what happens is when you create value, the pie gets bigger,
Right.
right? That's
Yep.
what happens.
Yep.
And I've
100%.
learned the value of partnering. It's
Yeah, I
so
mean, it just it makes sense, and I would even argue like my mission. I want to have 100 people doing what I'm doing, right? Even if it
yeah,
means, that there's more competition in the market, because I feel like having 100 people doing it instead of maybe 10 of us, it's going to get more information out there, which will draw more eyes to it, which will increase the pie, which will then, I may not make a lot more money. I may not reach a lot more people personally, but I know the industry will serve for it and the pie will get bigger. And my piece of that pie may get smaller, but it doesn't mean that my world gets smaller. My world will probably still expand, you know?
what if whole life were as popular as retirement accounts? What if people put as much money into whole life as
Dude,
they did retirement
dude, the
accounts? What
world
if
would be
this
a
were
different
standard,
place.
right?
Dude, if everybody were to get do what we talked about and get a term policy and a whole life policy and have a living benefits term, a convertible term to meet their potential net worth, and then have a whole life policy to save, and then every time they had a kid that was 14 days old or older, got a good policy on their kid, that a whole life policy that would last for life. Our debt crisis in this country would be solved in one generation. That's it. Like legitimately, we have the solution to the entire debt crisis and the personal spending and debt crisis that we have in this country right in what we do. But the problem is people, are out there misrepresenting what life insurance companies are supposed to be doing for people. And then, then the other side of it, what you said is like people aren't willing to do the work and think long enough term and delay gratification and all these things. And so I don't know, like but you can only help the people that raise their hand and the people that like have the vision. And that's why it all starts with psychology and emotional balance, right? I played poker for a living for 7 years. At my peak, I was ranked number 64 in the world. And
Amazing. That's
everybody
amazing.
asked me like, what made me so good? Was I good at reading people? Was I good at bluffing? Was I good at like whatever? And the answer is no. I was really good at math. I knew the statistics. I'm just like life insurance. I'm a nerd for the numbers. And I knew literally the statistical value of every single hand versus every single hand and what the odds would change based on the flop. And I could tell you to the 0.1% with 5 people in the hand or 2 people in the hand or whatever, every person's chances statistically. So that's one part. So you got to know the numbers. That's the logic. But that's not what made me good still. What made me really good is just staying even, not getting too high and not getting too low because there's always variance, and being able to have emotional control and not make emotional decisions based on the fact that maybe I just took a bad beat or maybe I just got really lucky. So now that impacts my decision. Just staying even and making good, solid decisions and being emotionally balanced. That's what made me amazing at poker. And honestly, you look at those correlations and how it goes into the personal finance space, and it's like, it's the same exact principles that made me successful here. And so if people would just think about your key to success has nothing to do with the clubs you use, the products you use. Whole life insurance is not going to solve your problems, but utilizing whole life insurance as a foundational asset is going to force you to grow. It's going to force you to evolve. It's going to force you to become who you need to be to live that life that you want to live. And some people just don't want that, right? And that's just, if you don't want to do the work, right? Like, but when I say you got to align your money with your values and beliefs, are you willing to, like Life 180, living intentionally for excellence? That's what the LIFE stands for, right? And so are you willing to live intentionally and start with the end in mind and be real intentional and sit and take the time to know the life that you want to create for you, for your family, for your business partners, for your communities, for all these things, and then actually reverse engineer a plan to get there and then execute on that plan? Like, most people are so reactive in life. They're not proactive and intentional about what they're trying to do. And if you want to live a reactive life, then this isn't for you. That's just, I mean, it'll still help you, but it's probably not going to align with who you are. And like, you're not going to see the value in it. So therefore it doesn't have as much value.
Yep. One of the things I see that I think that this might get you a bit triggered, but
Okay, here we
uh,
go.
so this happens more often than you might think.
Okay.
I meet people and I start talking about the infinite banking concept. And they say, "Oh yeah, I'm already doing this. Yeah, I know about this. Yeah, yeah, yeah. I work with this other guy doing it." I'm like, "Oh, okay.
Sure.
Can I see what you got?" Right? And usually they don't give me anything, but sometimes they will. And
Mm-hmm.
invariably, what they give me is a variable universal life policy. And
Mm-hmm.
I take a look at it and I'm like, this is not a whole life. This is variable universal life. And I start talking to them, trying to figure out like, how did you equate infinite banking with VUL and how did you end up this way? And this is what it is.
Mm-hmm.
And they do the same thing if you're a financial advisor looking at investments. They say, Chris, uh, do you want a low return on investment, a medium return on investment, or a high return on investment? Right? Well, if you want a low return on investment, then you want whole life. If you want a medium return on investment, you want indexed universal life. And if you want a high return on investment, then you want variable universal life, right? I mean, that's what they're doing. You're young, so you need to be more aggressive and you'll get a higher return. So, higher the risk, higher the reward. And invariably they end up with variable universal life. I see this a
Mm-hmm.
lot.
Yeah, I mean, it happens all the time. I think the ironic part is that it's all just marketing, and these companies, if you look at the end of the day, whether it's traditional universal life, index universal life, variable universal life, the thing they all have in common is the universal life chassis to it. The platform of the universal life, which is simply an annual renewable term platform. And
Right.
with that, the costs and the controls and the levers, the expenses, the fees, all of those have variables that you're not in control of. If you go back, Universal Life is a failing product. It is a failed product, historically speaking. Index Universal Life has only been around since 1997. It's so funny. Everybody likes to tout it as this like amazing retirement income alternative. There's not one policy, like legitimately, listen to this. There's not one person alive that has successfully funded a policy for 20 years and then taken 10 years of income from it in retirement. Not one person alive has done this successfully. There's not one success case. Yet there are hundreds of thousands of people out there selling millions of products to people trying to sell it like this is the best alternative in the world when there's not even one success case with it. It's a failing financial experiment at this point in time. And, what they've done is they've bastardized all the success that the whole life insurance business and companies and the mutual companies have built over 180 years. And they've said, oh, Walt Disney did this, Ray Kroc did this, all these people did this,
They
J.C.
never
Penney, and
specify what this is, right? I run
right.
into that a lot. Oh yeah, my
It's nuts.
brother-in-law does this. Yeah, I know about this. They never
Yeah.
specify what this is, right?
It's
They just pick out
right.
like one word, like cash value. Oh yeah, 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 I know about that, right? It's like real estate. It's like if I come to you and I say, "Hey, Chris, I'm a big time real estate investor.
Yeah.
I'd like to teach you about how to invest in real estate." Yeah, my
Hmm.
brother-in-law is a realtor. Yeah. I already own a house. I'm already doing
Hmm.
this. I already own a
Hmm.
house. I know all about this, right? Or,
Hmm.
hey, I'm going to teach you some super creative financing strategies so you can buy large properties for no money down.
Yeah.
Yeah, I know what a mortgage is. My brother's a mortgage broker. I know all about this. I'm doing this
Yeah.
already all day long, right? It really
Hmm.
is that ridiculous, you know?
Yeah. Yeah. It's crazy. And so for me, it's easy, and I'm guilty of it. And you've seen my videos. I probably do some of the most technical IUL videos and some of the like I'm a total nerd that loves to deep dive, so I'm as guilty as anybody else. But at the end of the day, none of that matters. Like at the end of the day, what matters most is your money in alignment with your values and beliefs? And are you being intentional about becoming who you need to be to live the life that you want to live? And I promise you, there's not a financial product in the world that will solve your problems as a human being to create the life you want to live. But, and when you use term and whole life and use those combinations of each other, it can help you. And this is where, when you align your money with your values and beliefs, and you are intentional about what you want to create and you're clear about what your values are, well, to me, if you're a decent person, you find a responsibility to take care of your family and community and things like that and whatever, and you want to like elevate yourself and you realize you need to save money, then this just becomes it just becomes something that falls into place and is a natural byproduct of you being intentional and you aligning your money with your values and beliefs. And you go, okay, there's no other asset that will do this for you. I do this thing where I talk about, and I challenge anybody, like, a lot of people call whole life insurance the Swiss Army knife of the financial industry, right? I look at it like this. There's not another product in the world that will grow with you and be versatile like a whole life insurance policy that's properly designed will grow with you. When you're in your 20s, you need to save money, right? And so it can be a great emergency fund. It's the perfect time for you to start building your emergency fund and build your financial foundation. Once you hit your late 20s, early 30s, you're going to want to start an opportunity fund and maybe start investing and start doing real estate, maybe launch a business, maybe do something like that. Maybe in your 30s, you get married. Maybe in your late 20s, you get married and you actually start to have a family and you actually need the insurance. So now the insurance is going to kick in. You've been saving, saving, saving. Maybe now in your 40s, your kid starts going to college and you need, a good college planning alternative. Now you've got access to capital that's not going to show up on your FAFSA. You're not going to have to, it's not going to count against your expected family contribution. It's going to be all these things. So you have all that money that works for you that you have leverage over in your 40s. When you hit your 50s, you got living benefits that will kick in as people, unfortunately, when we hit our 50s, sometimes health issues come up. Our odds of having health issues come up. And so you have those living benefits. When you hit retirement, now you've got a volatility buffer with an account that can be there as a bond alternative to your portfolio, to all the things that you have going on in retirement. And then when you hit later in life, obviously we want to figure out how to pass money on to the next generation. It's the backstop to our wealth. It's what protects our wealth to make sure that we don't destroy our wealth in our own life and we are able to pass it on to our kids. And so all in one product. Every phase of our life that we can grow through, this product will evolve and change with us. There is nothing else in the world that will do it for you. So when somebody says buy term and invest a difference because you're going to be able to self-insure when you're 55, it makes me want to like slap them. Like it just is so irritating to me. But it's when you really and if you start with the end in mind and you really are clear about what are my values, what are my beliefs, what do I want to create, what are the things that could derail me from being successful, and you look at all that, I just walk through all these things in life that everybody's gonna have to deal with at some point in time, most people at least, right? And so if you have this product that can solve all these problems, I think there's a lot of marketing out there that says we got to get $1 to perform multiple functions, right? This is what we mean.
Yeah, yeah, yeah. Well, there's so many things I want to talk about, but I'm going to change the topic slightly because one
Okay.
of my big things I think you'll agree with is so offense wins games, defense wins championships. I like sports analogies, okay? When
Yep.
you play defense, you have to play defense as a team. It does you no good to have three walls of your castle defended and then leave the fourth wall undefended, right?
Sure.
So it's better to have more modest protection, but be protected across the board than to have
Yeah.
like super robust protection in one area and leave one area
Sure.
un. Okay.
Unless you got
One
Ray Lewis in the
asset,
middle.
one asset that
Yeah.
we all need to protect that people don't even think about it as an asset is your insurability.
Mm-hmm.
Your insurability is an asset and it is a temporary gift. Either through age or through health, you will become uninsurable at some
Or
point in time.
accident.
Right. And we all have a limited amount of insurability. If you want to
Mm-hmm.
buy mutual funds, there's no limit. Buy them all day long. Wall Street will take your money all day long. You want to buy
Yep.
whole life insurance?
Yep.
There's a limit. They're not going to give you as much as you want, and you have to qualify for it. We
Mm-hmm.
know the product is good. The question is, are you good enough to qualify for it, right? So
Mm-hmm.
especially if you're young and healthy, you need to protect your insurability. You need to secure your right, reserve your spot in line to get access to this solid gold while you still can. And that's
Yep.
where convertible, in addition to whole life, a convertible term policy
It's
is
huge.
so huge because it protects your insurability.
So the
Um,
one,
you- yeah, go ahead.
yeah, the one thing I want to say, and it just popped into my mind, there's a lot of different convertible term insurance policies out there. The key is what's it convertible to, right? And so you could buy a convertible term insurance policy with an IUL company and it will come be IUL product. Make sure when you buy a convertible term policy, get a convertible term policy with a participating mutually held whole life company that will allow you to actually participate it to a solid product, right? Like, and so that's the only thing I want to say because
Yes.
I don't want anybody getting bait and switch, being like, oh, I got this convertible term with Transamerica, you know, like, you know, like that'll be horrible, so that's that. And then, to your point, what you said is like, your insurability is not guaranteed. It's a gift. And a lot of people are like, oh, well, I'm healthy. I eat this, I eat that. Well, guess what? I know plenty of people that are like, my father-in-law's boss, he was a broker with AG Edwards, Wachovia, Wells Fargo, all those places, so it's a pretty funny story, but well, mine and my father-in-law's relationship is pretty funny based on his background and my beliefs and my background. And Thanksgiving, Christmas conversations are always fun. But he had a manager named Paul, and Paul was like the dude who every lunch break would go out on runs, and he always ate organic and all this stuff. At 52 years, Paul died of pancreatic cancer. And and I remember when he got it, everyone's like, how did this happen to him? How did he get sick? He's like the healthiest guy we know. No matter what you do, stuff happens, right? Like health issues happen. We live, and this goes back to what we were saying before. You could eat as healthy as you want, but that means different things. It's one of the reasons I'm excited about being in the DR. We control our food supply. You know what I mean? Like everything is actually organic. It's not poisoned by the world that we live in. We're not in this super toxic environment that we're surrounded in, because that toxicity creates sickness no matter how intentionally you think you're being about your health. So A, you can get like bit by that by surprise. And then B, I'll share, my wife has been in long-term recovery since 2009. She's been sober and, alcoholic, whatever. And for a while she wasn't insurable, because if you know anything, like when you're first newly in the program, they won't insure you, going through all that. And so she just was about to hit the period where she was going to be able to get insurance, and then we got rear-ended in a car accident, and she got a traumatic brain injury. And it was no fault of our own, no fault of hers. But then because of the traumatic brain injury, she couldn't look at a computer screen for 3 years. She couldn't do this, she couldn't do that. And so to this day, she still does not qualify for insurance because of the fact of, granted the alcoholism thing was a different thing, but right when she was about to qualify, it was a 7-year thing. We were told, like, once when it hit 2016, we were going to apply for insurance. But then in April 2015, we got rear-ended exiting a highway. Somebody hit us going 50 miles an hour right in the back. And she was looking back at our newborn baby, and because she was turned, she whacked her head, and it was like, really bad at 50 miles an hour. And she got this traumatic brain injury, and it still affects her to this day. It's getting a little better, but because of that, and because she's had so many appointments with neurologists and all this stuff, one moment in time took her insurability away from her. So anybody that thinks you're immune and that you got this licked and you're covered and you could do it later,
This is
think
why
about
one
that.
of the things that really irritates me about the standard Wall Street approach is they
Mm-hmm.
always talk in terms of probability, right?
Mm-hmm.
The market will most likely go up.
Mm-hmm.
Well, you
Mm-hmm.
know what? It's pretty unlikely that your home is going to burn down. So, you know what? If you're really going to take that to its logical conclusion, you don't need homeowners insurance. You don't need car insurance. You don't need any form of insurance. It's pretty unlikely any of these things are going to happen, right?
Mm-hmm.
Yeah, and maybe it is likely that the market, which is not a market,
Yeah.
goes up at a certain rate.
Yeah.
Are you going to gamble your entire retirement savings on that proposition? I don't care how likely it is. That's like just
Yeah.
walking into a casino. You played poker, you can play the odds, right? I mean, you can set the
Sure.
odds in your favor.
Yeah.
Are you going to do that with your retirement savings? I mean, it's
Yeah.
okay to do that with, reasonable position sizes. It's okay to speculate. That's
Mm-hmm.
fine. But
Sure.
understand what you're doing. To your
Yeah.
point, do it intentionally. Like, okay, I'm going to take money I can afford to lose.
For
I'm going to
sure.
put it into an asymmetric risk situation where I'm not
Mm-hmm.
shooting for a 10% return. I'm shooting for a
Totally.
10,000% return, right?
Totally.
And if
Yep.
I lose the money, maybe it was worth the trade-off. Maybe it was worth the risk,
Totally.
right?
Totally.
Right? And I've got to be emotionally distanced from those speculations too, for sure.
Yeah.
But yeah, I wonder if that's something you've thought about, because that's something that just putting your money in alignment with your beliefs, right?
Mm-hmm.
In no other aspect of our financial lives would we ever accept a probability. If I'm going to hire you as a full-time
No.
employee, I'm going to say, Chris, it's pretty likely we'll pay you your salary. I mean, we've done it, for 10 years in a row. Pretty
Yeah.
likely,
Yep.
90,
Mm-hmm.
95% chance we'll pay you, but we may not, and just sign this paperwork acknowledging that that's a risk and we're not obligated to pay you
My
anything, right?
my guess is if you were in, I grew up in Vermont and I live in Arizona, so I use like an analogy of like going from Vermont to Arizona, right? If you were in Vermont and you needed to fly to Arizona, and you got and you got to the airport, and the flight attendant, as you're boarding the airplane, goes, listen, there's a 50% chance this flight's going down, right? Are you going to get on that plane? No. If they told you there was a 10% chance that flight was going down, are you going to get on that plane?
No.
But what if you had to get to Arizona and the only other alternative was you to get on a bike and ride there by foot? And you had to be there in like the next year.
I guess you're going on foot.
You go on foot, right? You go on the bike. You're not playing, right? But that's the thing, is like we do this. We talk about probabilities. When you're talking about probabilities with your money, there's no room for error. You either get it right or you get it wrong. And if you get it wrong, it's over. Like,
Yep.
you cannot get this thing wrong. So why is everybody giving up control of one of the most important results in their life to other people that are financial advisors? They're financial salespeople. Like every single person in the world. The greatest con in financial history is this whole fee-based financial planning. Like, we only make money when you do. No, they don't. They make money. They'll make more money when the market goes up. But even if the market goes down, it compounds your loss because they're getting paid their 1-2% no matter what. Like the financial, the fee-based planning garbage that's happening in the business right now was a way that Wall Street has figured out to be like, all right, we don't want to be seen as stockbrokers anymore because brokers are salespeople. So we're going to become financial planners. And this whole movement happened in the late 90s, early 2000s, after the dot-com bubble, ironically, right? After all these stockbrokers sold all these stocks that got massacred. So the early 2000s, there was this wave of movement to fee-based planning because of perspective and emotional regulation around it all. And so what they've done is they said, all right, we're going to annuitize our own business. If anybody knows anything about an annuity, they are simply annuitizing their business, creating a constant stream of revenue and cash flow for the financial advisors of the world. If you think that they created financial fee-based planning for your benefit and not theirs, I can't help you.
Yeah. Well, let me just say too, it's not for the benefit of the financial advisors. They get churned and burned all day long, just like life insurance agents. It's the institutions that are employing them, right? Because I do want to I don't like, raining on your average financial advisor, because your average financial advisor is not the problem, right? And he's the one who's going to get thrown under the bus. The powers that be will say, oh yeah, he did a horrible job, just throw him to the wolves, right? When he's just an average guy trying to make a living, and he's just doing what he's been told. He's doing what he's been trained to do. Peter Nelson did it for multiple years until he later saw the light. He was not a bad guy. He was just trained wrong. The problem is not this little financial advisor. I don't want to beat up on the little guy. It's the people at the top who set up the whole system, designed that way, right? So your average financial advisor, the financial institutions don't care about him. They don't want him to benefit at all. They just want to use him, turn him, burn him, right? And this gets back to another one of my big pet peeves. Everyone jumps to this one useless metric all day long. Return on investment. Like, it's all about return on investment. Like, I'm trying to explain to them the infinite banking concept and they cut me off. Look, just cut to the chase. What return can I get?
Yeah.
Okay, the whole premise behind return on investment is I'm going to deliberately give up control of my capital, park it in somebody else's jail, and then hope and pray it goes up in value, right? So first of all, even if you think return on investment is a relevant metric, it's all phantom. You have no guarantee. They're just projecting. I can make up numbers all day long. 8%, 10%, 12%. I can make up numbers all day long. It's all fantasy. But even going back a step, it's not about return on investment. It's about cash flow. So why, Chris, and I think you're going to hear me tell you, why do people get so hung up on this metric of return on investment?
Marketing. I mean, that's what they want you to focus on. If you don't live a life by your design and by your intent and with your own critical thinking, you're going to live it by somebody else's, and that's just what they do. What's the reason why every time you go to Fox News or CNN or whatever, all of the advertising is either pharmaceutical companies or financial companies trying to sell you? Like, think critically. This goes back to, are you willing to take control of the results in your life? Like, I don't want to rain on the like average financial advisor, but I will be critical of them and say that they're not being critical enough thinkers. And that, or maybe they're trying and they're just in their growth process and they're just too new in the process, and they'll come to their own awakening soon enough. And then some people just get stuck in it. I mean, I see it on my YouTube comments all the time. People that just think they got it figured out and they think I'm wrong and they like to rip on me. And it's like, and you can just see how like factually driven like all their statements are and how emotionally driven. And I can see when they're programmed by the institutions. I can see when they're actually just regurgitating what they learned when they were in class at Wells Fargo to learn how to do their job, that's what I see all the time. And so, I guess it just comes down to, listen, you just need to be intentional about what you're after. You need to be intentional about what you need your money to do for you as a tool, and you need to be thinking about results, not returns. You need to think about this is where we go. Returns are on a spreadsheet, results are in life. And that's where I always say life doesn't exist on a spreadsheet. Like, that's what I'm talking about. You can show me projections, but if you look at any pro forma for mutual fund or investment, it says past performance is not indicative of future results. It's there. There's an asterisk. It's all there. They're trying to tell you. But nobody wants to listen.
I was talking about this before. I'm sorry to cut you off, but I had to.
Go ahead.
Why do you think you have to sign all this paperwork? Is it because they're trying really hard to make sure you understand what you're getting into? Or is it so they can protect themselves from liability?
Yeah, it's
So
avoidance of
when the
liability.
market goes down, you
Hmm.
can't sue them because they can say, hey, you
Hmm.
signed the paperwork, you said, right? And the whole
Totally.
process, this is another one I get into, is designed to manipulate you into saying, well, I want the highest
Yeah.
risk possible
Yeah,
because
for
they
sure.
equate high risk with high reward, right? And
Hmm.
when you think that way, everyone's going to say, well, yeah, I want to be with the cool kids. I want an aggressive portfolio, right? Which is a
Yeah.
marketing term. It's not
Yeah.
actually like based on anything scientific. It's just, yeah, but you don't want to be with the boring, safe, stodgy stuff that's like for your grandma. You don't want that. Like, come
Right.
on, get with the cool
Well,
kids.
well, it's interesting you say that because if you look at the results of whole life insurance and you look at the people that actually had whole life insurance, 70% of people had whole life insurance back in the 60s. And then there was, then there was a slow, ERISA was created in 1976, 77, and then 401ks really came out in 1978, came popular in 1981, came really popular in 1983 when they made it so employers could contribute to them at the same time. And the funny thing about the expectations of market returns, even if we go into all right, rate of return matters. Like, let's just say they're right and we're wrong, which we're not, but like, let's just live in a bubble for a minute. If you take out 1980 to 1999, if you remove that 20-year window of time from the equation, the average return in the stock market is only 5.2%. And so it's atrocious. It was 15.4% from 1980 to 1999. That elevates all of the results in the numbers. And the question is, the most powerful word in the world is why? Why was that the case? It's because in 1980, when 401ks came out, your average everyday employee that never invested in the market at all, now all of a sudden is investing in mutual funds and stocks. And it's like everybody's jamming money we went away from this defined benefit plan with pensions to a defined contribution plan with 401ks and qualified plans and IRAs and stuff like that. And so now all of a sudden we have everybody flooding into the market. And we also at the same time had interest rates at all-time highs. And so asset prices were struggling in the early 80s. And so that led to the booming 80s, right? That everybody flooding the market while we're going through this declining interest rate environment, which also drives up asset prices. And then we had the dot-com growth and the bubble and the creation of cell phones and mobile devices and the internet. The perfect storm of that 20-year period created unrealistic results that will never be seen again, probably. Not in the markets, right? You can create those results if you're creative enough to go out and create something on your own and build skill sets and do things. You can absolutely go do that with artificial intelligence and all these things. And there may be, opportunities here and there for sure. But on a widespread spectrum, 1980 to 1999, when people go, oh, you need to invest in a 401, go to school, get a job, invest in a 401k. My question is why? Well,
Right.
because
Right.
my parents did it. Well, guess what? What worked for my parents won't work for me because
Mhm.
the environment's different. The rules are different. They were living in a decreasing interest rate environment. We're living in a flat and increasing interest rate environment. How the markets, the correlated movement of the markets, how assets perform, the different types of asset diversifications that you need are going to be completely different because the environment is different. The metrics, everything is different. So why are we going to do things the same way? It's like, that's insanity. Like, let's just keep beating our head against the wall, Like,
Chris, you're so not passionate and boring. I wish you would tell me what you really think.
well,
But I do like what you point out because there's a word that is oftentimes misused
mm,
that I like, and the word is traditional. So
mm,
sometimes people refer to, oh, you don't want the traditional financial planning. I'm like, there's nothing traditional about modern financial planning. It's not traditional. What you point out is that whole life insurance was traditional. The
yep,
average American household had whole life insurance. They viewed it as a bedrock savings vehicle.
mm-hmm,
This was back when we had more sound financial institutions. We had more sound financial advice. And
mm-hmm,
the idea of quote unquote saving for quote unquote retirement by
yeah,
throwing your money into this Wall Street casino where you have no control over it and no access to it for decades would
yeah,
have been just bizarre to the average American household in the early part of the 20th century. They would say, first of all, that's not saving.
right.
That's not even investing. That's speculating.
What's
And
funny, what's funny behind that is I looked at the statistics of this, and back when the US debt was at $27 trillion, it's at like 33 trillion now. But back when I looked at the debt of 27 trillion, ironically, there was $27 trillion sitting in 401k accounts in the country. And it's just like somehow everybody's been duped to give up control of your money and give it to the US government and let them kind of do what they want, because people don't realize when you put your money in a qualified account, you're basically giving control of it to the government, and they get to tax that money away from you at their whim. You are basically getting into business partnership with the most financially irresponsible institution the history of the world has ever seen. I don't know about you, that doesn't seem like a good deal to me. But and I always tell people, don't do what your parents did with their money. Do what your great grandparents did. Because if great grandpa's still alive, go talk to him and say, hey, great grandpa, like when you were younger, what'd you do? Right? I guarantee whole life insurance is involved 90% of the time.
Yeah, and with retirement accounts now, it's like they take your money by default. Like you have to actually consciously opt out, or they automatically take your money and put it into a retirement account. And in some cases, it's mandatory because you know what, Chris, they're trying to help you.
Yeah.
So
Yeah.
whose money is it really? That's my question. Whose money is it? If I never see it, it never
Yeah.
hits my bank account ever.
Mm,
What I like to say is we talk about statement wealth versus contractual wealth. I'm sure you're familiar with
yeah.
that, but it's like the number you see on your statement is just a form of false advertising,
hmm
right? And I see this with clients where they have a lot of money in a retirement account. And as they start learning, they're like, maybe I shouldn't have my money in a retirement account, right? And then they're like, oh, but then there's all these taxes and penalties. They're going to punish me, right? If I try and free the hostages, there's a ransom you got to pay. And, my response is, look, you have $1 million, and after taxes and fees, the cash surrender value of that asset, as Ben Penn would say, is really only 500,000.
Right.
It's like, yeah, but I want to give up the 500,000. No, that $1 million number is fantasy.
hmm
You don't have $1 million.
It's not yours.
You have what you can get out.
hmm
And the opportunity cost of you leaving that money in there is going to be way more than if you just pay the ransom, pay the jailer his ransom, free the hostages, right? Get that money out of jail and into your control,
hmm
right? Because
hmm
that $1 million number, it's just false advertising.
Yeah, it's
But
funny. I
here's
mean,
the other
everybody
side.
wants to avoid the taxes and penalty.
Yeah, well, I think it was Cody Roos who pointed this out. I hadn't thought about this. And he's not an
Mhm.
infinite banking guy at all, not a whole life
Yeah.
insurance guy.
Yep.
But he said they charge fees on that full amount.
Mm.
Even the
hmm
money that's not yours. Of that million, maybe half of it is yours.
hmm
They can
But you're
charge
getting
fees
paid fees on all of it.
on the full amount.
Totally. And it's
So
funny because everybody's trying to avoid taxes and penalty. But when you talk to most people, you go, hey, where do you think taxes are going? Down or up? Everybody will say up. And so, like, if they're going to go up and you're trying to avoid the penalty, well, you're like getting double whammied, by keeping your money in there. Pay the 10%. And I'm not telling anybody what to do. This is not personal advice. But for
right,
me,
right.
if I had $1 million in a 401k, I'd be like, I'm more than happy to pay the penalty to gain control of my money, and whatever taxes come out of it are going to be taxes that come out of it, because it's going to suck to look at the $300,000 tax bill or whatever. But at the same time, like, you're not getting out of that. You're probably going to pay more for those taxes later. And so just get it over with, pay the penalty to gain control. And, because if taxes go up 10%, well, you're going to pay the equivalent of that penalty anyway and still not have control. So, once again, what do you believe? What are your values? What are your beliefs? If you think taxes are going up, 401ks make no sense. If you're like a huge Hillary Clinton fan and you think taxes are good and they're going to be in control and our government's got our best interests and they got your back, well then probably keep your money. You're good with keeping your money in a 401k.
Yeah. Well, Chris, there is so many things we could talk about. As you're talking, there's like 16 questions coming up. I'm trying to control myself, but we're reaching the end of our time.
Yeah, man.
So kind of in closing, what are some of the thoughts you want to leave our audience with? What do you really want them to understand?
Yeah, I mean, I think it's just make sure you work with somebody who's going to help you actualize the life that you want to live. Money is just a tool to get there. No financial tool, no product is going to solve your problems. That rests on you. I would just be really intentional about think about what do you want to accomplish in this life? What are your values? What are your beliefs? I don't think enough people spend the time to slow down and actually contemplate that, like really deeply contemplate that. And so really think about that and don't choose an advisor, an agent, a coach, or whatever you want to call it until you're clear on what you want, because you're not going to be able to choose the right advisor to be able to know if they align with your values and beliefs until you're clear about it for yourself. You know what I mean? And so that's what I would say is like get really, really clear about that first, and then reach out to somebody like Logan or me, or like, or somebody local, or whatever it is. You stop being reactive if you are being reactive, and be proactive. Like, be intentional about what you're trying to accomplish, because you get one chance at this. If you got 40 years of like real earning capacity in your life, if you screw up 15 years of that, your odds of succeeding go down exponentially, right? So the opportunity cost of mistakes are through the roof. And so I would say for right now, for New Year's going into 2024, I would encourage everybody not to be like, how do I get out of debt and all this stuff? No, get really clear on what you want your life to look like and what you think you want to create in this world, and then take radical self-accountability for it. Get clear on those values and beliefs, and then find a person that aligns with who you are and work with them.
Well, Chris, thanks so much for your time. Really appreciate it. I hope we get the
Yeah, man.
opportunity to do this again. I hope this is
We
the first of
will.
many interviews. But yeah, thanks so much for your time, everyone. Thanks for tuning in. And this was Chris Kirkpatrick of Life 180.